sustainable investing has become a crucial topic for insurers. On the asset side, insurers seek to mitigate the sustainability risks that their investments could pose to, such as climate change-related risks, together with the potential financial and reputational consequences of it. And on the liability side, insurers whose core business is to insure risks naturally have a particular incentive to understand how these risks could impact their financial obligations. In addition to this comprehensive risk management, sustainable investing can potentially offer insurers attractive investment opportunities. For example, structural sustainability trends, like the transition to a carbon-neutral economy, imply significant changes in economic activity, and these can in turn generate new areas of long-term growth potential. Insurers are also more and more thinking about their end clients becoming interested in sustainability when selecting financial and insurance products. Another key driver of sustainable investing amongst insurers has been the increase in regulatory initiatives in response to the alarming acceleration of environmental issues. For example, in Europe, the EU set the goal of becoming climate neutral by 2050, as well as other ambitious targets in the European Green Deal. To meet these targets, significant investments are needed, and public money will not be enough here. However, the good news is that private assets can more than cover what is needed to reach these goals. Thus, insurers have the chance, via their investments, to become key facilitators of a more sustainable future. Accordingly, the EU is implementing measures to incentivize private capital to support sustainability via the Action Plan on Sustainable Finance. And currently, one of the most impactful elements of this plan is the Sustainable Finance Disclosure Regulation, in short, SFDR. SFDR applies to all financial market participants and financial advisors. Hence, it applies to insurers as providers of insurance investment products such as unit-linked life insurance policies. SFDR creates a framework for insurers to disclose how they integrate and manage sustainability factors. These disclosure requirements, many of which have been effective from March 2021, are based on the principle of double materiality, which comprises two pillars. First, the notion of sustainability risks, meaning the material ESG risks, environmental, social, and governance risks that insurers and their products are subject to. Second, principal adverse impacts. These are the potential negative repercussions of an insurer on the environment or on social dimensions. SFDR also impacts insurers with regards to product distribution, as financial products now fall into one of three categories. Article 9 products, which are products that have sustainability or impact as an objective. Article 8 products, which seek to promote ESG characteristics. And finally, Article 6 products that have neither sustainability objectives nor ESG characteristics. The classification of a product is consequential because it's likely to influence who it can be distributed to. In fact, SFDR impacts the sustainability suitability assessments in distribution directives such as MiFID and IDD. For instance, if an insurance taker expresses strong interest in sustainability, it's possible the insurer will have to offer Article 8 or 9 products only. Like the other measures on sustainable finance, SFDR requires insurers to take stock of where they are in terms of sustainable investing and how they can move forward. To do that, a helpful approach can be to look at 5 elements. 1. Negative selection. This will resonate with some of the risk management requirements of SFDR, for example. 2. Positive selection. And 3. Impact. These can be linked to SFDR's classification of Article 8 and 9 products. 4. Engagement. And 5. Voting. These address the requirements of the Shareholder Rights Directive and can also form a part of Article 8 and 9 products. The implementation of SFDR is also a good occasion for insurers to look at the opportunities that sustainable investing can offer and how to best capture them. For example, many studies indicate that, generally speaking, portfolios with higher ESG scores display relatively attractive return potential. Opportunities can also be found in carbon reduction strategies, and another example are thematic strategies, with themes that are often linked to the UN Sustainable Development Goals and strongly supported by regulation, such as climate change or the circular economy.